Good morning, students. Welcome back to the session on this consolidation that we have been discussing. In the last session, we covered various aspects related to consolidation. We also understood the consolidation procedures, wherein the balance sheet was consolidated. And I also gave you a few questions for homework. I am assuming that you would have completed that. If there are any questions, doubts around that part which we discussed, you can just feel free to let me know. Now I'll move on with the consolidation procedures. And this is about the preparation of the consolidated financial statements, wherein some more adjustments are required to be incorporated. So some of the adjustments which we discussed were about a computation of goodwill, capital reserve, minority interest, then the reserves and surpluses which are required to be allocated between the acquisition period and the post-acquisition period. Now moving further on to that, when the financial statements will be prepared, considering the fact that when the financial statements are prepared, group which comprises of many entities is considered to be like a single economic entity. Remember the basic premise on which the consolidated financial statements are prepared. There is a very common adjustment which is found is about the elimination of intra-group transactions. Means any transactions which would have taken place between the group companies that are getting consolidated are required to be eliminated. Why? Because it's consolidated as if it's a single entity. So therefore, because it's getting consolidated, considering this to be a single entity, that's why it's very, very important that any of the transactions between these companies within the group get eliminated. So now moving on to those adjustments, we will have a discussion on that. And if you can all move on to page number 10.37. 10.37 and of course 10.38. Okay, so this is about elimination of those intra-group transactions. Yeah. See this. Elimination of intra-group, or we can say intercompany transactions. Say there's a holding and there's a subsidiary. Subsidiary has sold goods to, holding has sold goods to subsidiary. So in the sales of holding, let's suppose 50 rupees is towards sales to the subsidiary. Now, in respect of this, subsidiary would have recorded the purchases, and let's suppose in the purchases of subsidiary, these purchases of 50 have been recorded. Okay. Now, when the consolidation will be done in respect of the adjustments, what will happen? This 50 will be eliminated, and this 50 will also be eliminated. And what will be the result? What will be the total? Total will be 100 minus 50. And let's suppose if subsidiary has got sales, so that is 20. So what will happen? This will become 70. Now let's suppose holding has got purchases. Say this was 100. So now what will happen? This will become 200. That means 100 plus 150 minus 50. Okay, clear on this? Yeah. Now, in respect of the adjustments, in respect of all of these adjustments, it's important to understand first of all the underlying transaction. Because till the time underlying transaction is not understood, it will not be possible to eliminate all of these intercompany transactions, because only when the understanding is obtained, then the management will be able to do this. Yeah. And that is also one of the areas in respect of consolidated financial statements, wherein the chances of missing out of any of these adjustments is possible. Yeah. And for this, generally, what do? We look at all of such parties in terms of recording of their transactions when we eliminate them. Anyways, for our purposes, all of such information will be available in the question, so we don't need to get into that problem at all. Now, further to this, when H would have sold goods to S, okay, which is amounting to 50. Two situations are possible. Either the goods are unsold as at year end, means at the end of the year when the financial statements are required to be prepared, either the goods are unsold or the goods are sold. And I'm talking about all of such goods. Now, this is an important concept for all of you, and that's why I need your attention. See, in case H has sold goods to S, then S must have added some profit on those sales. Correct? Let us suppose cost of such goods to H was 40, on which H added a profit of 10 and then made the sales to S. And when S would have sold such goods, S may or may not have added profit, but the important thing is this 50 would have been sold, means rupees 50 has been realized, wherein not only the profit which S would have charged, but also the profit which H would have charged has been realized by the group. Means the group has received that payment. Yeah, or even if that is collectible, that has been finalized. This is called as realization of profit. Means the profit is realized. There's no doubt about it. It's been finalized. And if the profit has been realized and the goods are not there with the group anymore, then if we eliminate sales of H and purchases of S, it's good enough, because in the transactions we have eliminated the impact of intercompany transactions, which was in the nature of sales and purchase, and there is no real inflation of sales, we can say. Why? Because if we keep this sale in the total consolidated financial statements, then it would be inflated sales, in the sense that the sales within the group are also appearing. Okay. But another situation wherein, let's suppose the goods remain unsold. Let's suppose if we go to the next situation wherein the goods remained unsold, then let's see what is the impact. Let's try to understand what will be the impact in such a case in the financial statements. If the goods are unsold, this would mean that S must be having an inventory of rupees 50. Correct? I am assuming there is no processing cost, etc. It's all trading setup. Okay. Now, in relation to the purchase and sales, elimination has taken place. So the P&L to the extent of purchase and sales between the group companies has been adjusted, but there is an inventory which is lying with the group. So when the group, I'm talking about the group, every time I talk about the group, I'm hoping that you now understand and appreciate. Now the group will have an inventory of rupees 50, which is unsold. And also there is a profit element of rupees 10, which is loaded in this inventory. Correct? Now let's think of a situation wherein if the goods were not sold, then what would be the amount at which this inventory would have been appearing in the group? Because that's the position we need to take. Because what is it that we are trying to do? We are just trying to eliminate this transaction. If H would not have sold the goods to S, then the inventory would have been lying with H at rupees 40. Correct? Then this inventory would have been lying with H at rupees 40, and at the group level, inventory would have been appearing at rupees 40. Now, because H has sold the goods to S, and even if we have eliminated sales and purchases, still the inventory has to continue in the group. But by chance, in this situation, what we see is that the inventory is still loaded with a profit element of rupees 10. And what is this profit element? This profit element is towards the sale between the group companies. So is this acceptable? No. Can this continue? No. So that's why whenever we have such type of transaction, one additional impact that we need to eliminate at the group level will be the elimination of this profit. Yeah, correct. So we will have to eliminate the profit from this inventory, because if we keep this profit in the inventory, then because the inventory will increase my profits. Because the inventory will increase my profits, so what will happen? At the console level, inventory will go and that will inflate my profits. And of course, the inventory also gets recorded at an increased amount, which is not appropriate. Yeah. So this rupees 10 needs to be eliminated. Now, because of the fact that the inventory has not been sold, so what type of profit is this? Because of this, we will say this is unrealized profit. This profit is called as unrealized profit. Understood? Yeah? Clear on this? So whenever we will have such type of transactions, all of these types of unrealized profits, etc., would be required to be eliminated. Okay? Yeah. And you must have understood the purpose. Now let's understand how would this elimination take place. So two situations are possible. Let's understand. First situation is the one wherein holding sells goods to subsidiary. This is called as downstream. Downstream means it's coming down from holding to subsidiary. Another situation is wherein subsidiary sells goods to holding. This is called as upstream. wherein goods are moving from subsidiary to holding. Goods are moving upwards. In case of both the transactions, inventory, if that carries, okay, so if we have inventory at the year end, if there is inventory at year end, so what will happen? In both the cases, if there is inventory in respect of goods sold by holding to subsidiary or subsidiary to holding, unrealized profit needs to be eliminated. In such a case, okay, unrealized profit needs to be eliminated. Yeah, but as regards its second impact, because if we are reducing the impact from inventory, then of course second impact also needs to be taken, because it's all about double entry. So where would the second impact go? For this, I would suggest if you can look at this flow chart on page number 10.39. And this can also be a reference for your revision. In case it's an upstream transaction, then other than decrease of the amount of inventory by this unrealized profit, this profit element will also be eliminated from holdings, reserves, and minority interest, because this must be sitting in the reserves of the holding. Yeah, sorry, this must be sitting in the reserves of holding as well as minority. Why? Because these would be appearing in the profits of S, which would have got distributed to minority as well as parent. However, if this is downstream, then such profit needs to be eliminated from holding company's P&L in full. Why? Because in such a case, it would not have gone to minority, because who would have recorded that profit? H. And that's why this entire profit will get eliminated from the P&L of H. Okay, clear? Simple and easy to understand. Now we will be able to, I think, get more understanding around this when we move on to illustration number 8. So let's look at illustration number 8. This is page 10.40. I can see some queries from your side. Let me just look at those. So Sukanya is asking about internal reconstruction. Let's discuss about it towards the end of the session, please. Moin is asking, if the goods sold case, there's a net profit of 5, which we will consider. I'm not sure where you picked this figure of 5 from. Can you please let me know how did you get this profit of 5? Because in our example, we had this profit element of 10, not 5. Huh? Shubhat has completed the homework. Very good. He is confirmed. Radha is asking, sir, this type of adjustment of unrealized profits is there in amalgamation wherein it is adjusted with regards to goodwill or capital reserve. The purpose remains the same, but the treatment is changed. Absolutely correct. So it's the same thing which is there in case of amalgamation also. Absolutely same. So the concept is all same. The concept has not changed. It's just that that concept has got repeated or sort of used in case of consolidation also. Yes. Any more questions? Then we'll move on to illustration number 8. And you can also start reading illustration number 8 and start solving this, please. It's all based on that elimination concept we have already discussed. Okay, so let's move to illustration 8. A Limited holds 80% of equity and voting power in B. So that means A is the holding, B is the subsidiary. A Limited sells inventories costing 180 lakhs to B Limited. So 180 to B Limited at the rate 200 lakhs. So there's a profit element of 20 lakhs. Correct? The entire inventories remain unsold with B Limited as at the end of the financial year, 31st March 2000 X1. Okay, so this is part A. Part B. Let's understand part B. A Limited holds 75% in B and purchases inventories costing 150 lakhs from B. So now it's other way around. A is the holding, B is the subsidiary, but B sells goods costing 150 lakhs. Cost is 150 lakhs at a price of 200 lakhs. So the profit element is 50 lakhs. Okay. These inventories remain unsold with A at the end of the financial year. Now you need to suggest how the adjustment will be made in respect of these two transactions in the consolidated financial statements, giving reference of relevant guidance or the standard. Now at times you may also be required to provide the guidance. Now where does this guidance come from? This guidance comes from AS 21. Okay. So like Aditya mentioned, this solution is running into number of paras. It's quite long, and that is because of the guidance which has been given over there. Okay, but guidance is all understood. So I'll just move on to the solution straight away. So looking at A first of all. Now in case of A, what do we need to do? Purchases and sales will get eliminated first. Yeah, purchases and sales will get eliminated. In both the cases, amount will be 200 lakhs. Secondly, inventory will also be credited, means reduced to the extent of 20 lakhs. And where will the impact go? This impact of 20 lakhs, who would have recorded? It's a sale from A to B. So that means this profit of rupees 20 lakhs would have been recorded by A. Yes or no? So that's why in the financial statements of A, this profit must be appearing, and which would have also moved to the consolidated financial statements of A and B. And that's why in the consolidated financial statements from the reserves of A, this profit element of rupees 20 lakhs should be eliminated. Okay, clear on this? Yeah. Let's read the solution also from the study material. This would be the case of downstream transaction. In the consolidated P&L for the year ended 31st March X1, entire transaction of sale and purchase of 200 lakhs would be eliminated by reducing both purchases and sales. Further, unrealized profit of 20 lakhs would be eliminated from the CFS by reducing consolidated profits or increasing the consolidated loss, whatever be the case, and correspondingly reducing the value of inventories. Okay, clear? I think, Moini, that you must be able to understand about this concept after this example, and I'm assuming that this doubt of yours will go. So I'm not coming to your point now. After this illustration, please let me know if any doubt still remains. Okay. Now moving to question number B. Now it's a case of upstream transaction. Here again, purchases and sales will get eliminated at the rate 200 lakhs. Because at the group level, these would be appearing at the rate 200 lakhs. And the inventory will also get reduced by an amount of 50 lakhs. Yeah. But this 50 lakhs profit would have been recorded by B at the standalone level. And when this would have got consolidated in the group, a portion of 50 lakhs would have gone to minority and a portion of 50 lakhs would have gone to A. So that's why when this profit will be eliminated, this should be eliminated from minority interest as well as parent share. And let's understand how. Unrealized profit of 50 lakhs will be eliminated in CFS by reducing inventory, number one. Further, A limited share of profit from B will be reduced by 37.5 lakhs. Why? Because this portion of 75 lakhs would have been recorded by the parent. And 25% of 50 lakhs will be reduced from minority interest. Why? Because 25% belongs to minority. So now this 50 lakhs would have gone to two parties. Parent 50 lakhs into 75% and minority 50 lakhs into 25%. Okay, so this would have been 37.5 lakhs and this would have been 12.5 lakhs. Okay, clear on this? Moini, I am hoping you are clear on this. Any other query from any of you, please let me know. Everyone clear on this? Quickly, any questions, any doubts that still remain? Please let me know. Okay, Shubhrat is clear on this. Great. Okay, so now we will move on to P&L, statement of P&L. We discussed about adjustment related to various entries in the balance sheet, as well as the P&L, as well as any other adjustment which may be flowing. But we didn't really prepare any P&L at the consolidated level. So now we will also move on to preparation of consolidated P&L. And the procedure for preparation of P&L remains same. So it's no different from any other item. So it's absolutely same. We can now move on to illustration number 9, wherein we will prepare consolidated P&L. And the concepts are all same, which we have discussed. Okay, so there's no new concept which we need to understand around preparation of consolidated P&L. Aditya shared the response for all of these adjustments. Good. So let's move on to illustration number 9. Illustration 9. H and its subsidiary S. They provide following information for the year ended 31st March X3. Sales and other income, increase in inventory, that means the change in stock. Raw material consumed, wages and salaries, production expenses, administrative expenses, selling and distribution expenses, interest, depreciation. Then we have this other information available. H sold goods to S of rupees 120 lakhs at cost plus 20%. Inventory of S includes such goods valuing 24 lakhs. Means out of those intercompany sales and purchases, inventory to the extent of 24 lakhs is still outstanding. Administrative expenses of S include 5 lakhs paid by H as consultancy fees. Means there is another intercompany transaction. Selling and distribution expenses of H include 10 lakhs paid to S Limited as commission. Once again, it's the same thing. H Limited holds 80% equity capital of S prior to, and this has been held, I think, from this period, in fact, from this period prior to X1, X2. H Limited to credit to its P&L the proportionate amount of dividend declared and paid by S Limited for the year 2000 X1 X2. So a dividend was received by H Limited from S Limited, which H has taken to its P&L. We are required to prepare consolidated P&L. Okay, a consolidated P&L is required to be prepared by us. Yeah. So you can all start preparing this consolidated P&L. I'll just wait for a couple of minutes for you to start and get onto the solution, and then I'll also start with the solution quickly. You can all start getting the solution, please. Start solving this, all of you. Go to the solution, start solving this quickly. Then I'll go to the solution. Start preparing consolidated P&L. Abhishek, I think we can discuss about this query later now. You can get on to the solution of illustration number 9 now. Okay. Okay, so let's go to the solution now. And once you are done, you can just start sharing your solution with me in terms of the final profit, etc. you have been getting. Yeah. So consolidated P&L is required to be consolidated P&L is required to be prepared, and it will again be a line by line addition of the P&L of H Limited and S Limited, and on which certain adjustments which are shown are required to be made. Consolidated P&L. So first we have revenue from operations. Then we can give the note reference. Here again, the notes should be given. So the total revenue, because we don't have any other item over here. So this will be note number 1. Then we have expenses. Under expenses, We will start with cost of material consumed. This is one. Then we have changes of inventories of finished goods. Yeah, this is number 3. Then we have employee benefit expenses. This will be number 4. Then we will have finance cost. Number 5. Then we have depreciation and amortization expense. Number 6. And then we have other expenses. Number 7. This will give us total expenses. And we don't have any taxation over here. So this, let's suppose, is A, this, let's suppose, is B. So the net profit before tax, A minus B. Yeah. So we'll start plotting all of these notes one by one. Okay. So moving on to note number 1. Revenue from operations. Now for all of you, it will be better if you can open all of these notes together. That will help you in terms of posting certain entries or certain transactions at 2 places. That will save time. Yeah. And you should practice this as much as possible, because by doing that you will be able to save time during exam. Sales and other income of H and S are given. H and S are given. So what's the amount? It's 5,000 and 1,000. 6,000. Then there have been intercompany sales. Those needs to be eliminated. Less intercompany sales. What's the amount? Goods worth of 120 sold at a profit of 20%. Yeah. Sold goods of rupees 120 lakhs at cost plus 20%. Okay. So this 120 lakhs is the amount at which goods have been sold. So this is eliminated. Then in the revenue, if you'll see, expenses of S Limited include 5 lakhs paid to H as consultancy fees. Means consultancy fees is the income of H which has come from S. So that will also go. Less consultancy fee from S. And what's the fees? It's 5 lakhs. So this will also get eliminated. Number 3, selling and distribution expenses of H. were incurred in respect of commission paid to S. Means the income, the commission income of S was received from H, less commission income from H. This was F. Okay. So all in all, what do we get? 5865. And 5865 is the amount which will go to the P&L. Yeah, and I think there's a bit of alignment problem. Now moving on to the next note. Cost of material purchased or consumed. Okay. So I'll have to clear this part. Cost of material purchased or consumed. Okay, again, if we start with this, we have the amounts of raw material consumed of H and S, which is 800 and 200. And I've been receiving your responses. Moini, I think, computed the revenue amount. Moini, you can just recheck your amount now. Meghna is asking after adjusting intercompany transaction. Okay, Meghna and Shubrat shared the response. Good. Spectrum is saying, sir, why the dividend income has not been included in the other income? Because it's already included. If you read the question properly, question says that the credit to the P&L for this dividend has already been taken. So we'll not duplicate this. Mukmala is asking about the underlying meaning of unrealized profit. I think we discussed about it. Every time you just speak about the underlying meaning. See, underlying meaning means the concept that we have discussed. So if there's any doubt around this concept, please let me know. Moini is asking, Moini is sharing the response for this change in inventory, 1196. So let me just check. 800 and 200 is for H and S. Okay. Moving further. From this, purchases will be eliminated. Because at one side we have eliminated the sales and now the purchases will be eliminated. Correct? Then we also need to include production expenses over here, which is 200 and 100. Production expenses, H and S, 200, 100, 300. Yeah. So what's the total amount that we get? It will be 1180. So 1180 is what we can take to the P&L now. Okay. Moving further on to note number 4. 3. I'll come to note number 3 later on. I'm moving on to note number 4. Four is about wages and salaries, which we call as employee benefit expenses. which will have wages and salaries H and S. So for H it is 800 and 150. 800 and 150. So this will be 950. Okay, then we have finance cost. Note number 5. H and S. This is 150. And do we have any adjustment over here? No. So this will continue like this. 150. Then we can go to depreciation and amortization. Note number 6. Depreciation and amortization. This is once again H and S. What's the amount? 150. 150. So this once again becomes 150. 150. Okay. Then we will move on to other expenses. We can move on to other expenses. Note number 7. For other expenses, for H and S, it's 200 and 100. It's 300. Okay. Now from this, consultancy fees which has been paid by S, that will be eliminated. Because at one place we have eliminated this from income. Now we need to eliminate this from expenses also. Then we also include selling and distribution expenses. This was admin now. Selling and distribution expenses. For H and S, what's the amount? It's 250. 250 is 250. And from this, commission expense will be eliminated of rupees 10. Less commission of 10. So what do we get all in all? 300 plus 250 minus 5 minus 10. So it becomes 535. Is 535. Okay. Now we can move on to note number 3. Let's move on to note number 3, please. And you can just keep sharing your responses. I have a couple of queries. Let me just answer those queries before I move forward. I see a note number 8 given in the solution, which seems to be a typing problem. So you should just ignore this note number 8. You should just simply ignore this note number 8. This seems to be a typing problem because we do not have any information about tax in the question. So that's why no such tax expense should come. Okay. Yeah. Okay. So moving on to the questions of Mukmala. Mukmala is asking, sir, is it compulsory to deduct unrealized profits, whenever there is intercompany sales, no. Unrealized profit will only be eliminated when it would exist. And as I explained you, when does it exist? When the inventory pertaining to the intercompany sales is still lying with the group. Sukanya is asking about calculation of unrealized profit. I have not done that as yet. Okay. Aditya is asking, sir, how would he have, how he would have treated dividend if we would have to prepare the balance sheet. See, the dividend doesn't only go to the consolidated balance sheet. Dividend also goes to the standalone financial statements. Is that correct? Yeah. And from the standalone, it gets consolidated. So the console balance sheet is required to be prepared by us, but the standalone financial statements are already prepared. And that is what we have been doing this. See, we are only doing line by line addition. We are not doing each and every entry. Correct? Okay, so let's move on to note number 3 now. Note number 3 is about changes of inventories of finished goods. And for this, we have H and S as 1000 and 200, which is 1200. Okay. Now, this is change of inventory in relation to finished goods. Now, finished goods, which are still lying in respect of intercompany sales and purchase, what is the amount? 24 lakhs. So now, in respect of that inventory, profit needs to be eliminated. Yes or no? So we'll say less unrealized profit. So what's the amount of inventory? 24 lakhs. Now what's the profit element in this inventory? So the question says the goods are sold at cost plus 20. So if the cost is X, then the profit will be 0.2x. Means it will become 1.2x. Correct? So that means it's 120%. It's 120%. So this divided by 120%. If we divide 24 by 120%, what do we get? We get the cost. So it's the simple derivation of cost. There's a profit element which is cost plus 20% included in 24. Now that needs to be brought out. So what do we do? Very simply, into 20%. So what's the amount you will get? Amount will be 4 lakhs. So 4 lakhs is what you eliminate from the P&L. So you will get 1196, which can be taken over here. And then you can just let me know, after this you can let me know what's the total of expenses. What's the total of expenses? and the net profit. Vaishnavi is asking, sir, in sales and other income, why did we deduct commission and consultancy fees? Because the sales and other income must have been including these two. Because otherwise, where will you take it? This will go to sales and other income. And if the sales and other income includes a component of sales and other income which has taken place between the group companies, that will get eliminated. It's an intercompany transaction. Meghna is saying, sir, in our illustration, provision for tax for H and S is given 1200 and 200, but in our illustration, it is not given. That's why we have eliminated this. Okay, and you should look at the new study material, please. All of you, quickly. I'm hoping that now you are clear on this, Kanya, about the unrealized profit. Mukmala, about this unrealized profit. Yeah. Meghna has solved this, and Meghna is saying so the total of expenses is 1769. Hence, now can you also let me know the net profit? What's the net profit? This is net profit before taxes. And you can also match with your answers. Shubrat is saying net profit is 4096. Great. So this is all about preparation of consolidated P&L. Can you see how simple is this? Yeah. Sakshi has got the same net profit. You can also check and let me know the profits which you have been getting. Aditya is saying net profit before tax is 1704. That seems to be a bit different from what we have been getting. Maybe you have taken the total of expenses. Huh? Vaishnavi has got the same answer. Aditya, you need to check the total of expenses, please. Shorla is saying, sir, the value of changes in inventory is negative in the book. Oh, yes, this should be negative. This should be negative. Sorry, I forgot to put the negative part. This should be negative. See, this is increase in inventory. If you read the question, this is increase in inventory. And because the inventory has increased, so that's why it will be negative in the expenses side. Okay, so that's correct. Yeah, thanks, Shorey. This will be negative 1196. I think this could be the reason why response of Aditya was such an increased amount. Vasudha, I'm hoping I clarified this point. Vijay Shankar is saying, sir, won't we record for dividend though it is income to H Limited? It's already done. Please look at the question. Huh? I see this to be a doubt. Please read the last para. H Limited took credit to its P&L. It has already been done. Amount of dividend which is paid by S. So this is already recorded in the P&L by H. So why do we record it again? It will be a duplication. Prakash is saying, sir, why the changes in inventory is showing negative balance in the study material? See, now it is also showing the negative balance on the board. Please understand the question. It says inventory has increased. So if there is increase in inventory, what will happen? Profits will increase because of this. But now, because of the requirements of Schedule 3, any change in stock is not shown on the income side. Instead, it's shown on expenses. So if this will be shown in the expenses, and it's something which is in the nature of increasing the profits. So what should you do? you should put negative number for that. Clear on this? Sure, I think for reconstruction we'll have to wait. Aditya has understood this, and I'm hoping that Prakash, you are clear on this, and Vasudha, I'm hoping you are clear on this now. Okay, clear? So we'll move. Okay, Aditya, Mohini, Vasudha, they have understood, and Shorya is asking about another question. Shorya, all of these questions I think we can discuss slightly later, please. Or maybe you can just be specific on your query towards the end of the session, it will be helpful. Now moving on to the next point, and that is about consolidation of cash flow statement. Now, as regards the consolidation of cash flow statement, it's again the same principle. So the principle is not different. And what's the principle? If we have two companies, P and Q, both the companies will be consolidated in terms of various items that they will have. You can also refer study material, please. So we are not really getting onto any illustration for this because conceptually it's one and the same thing. And the cash flow statement will have various components. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Yeah, so all of these components will continue. Whenever you will prepare a cash flow statement, you just need to do line by line addition. That's it. And in this respect, any of the elimination between the intercompany transactions should also be done. And it will be great if you can start on this cash flow statement from the consolidated balance sheet, because therein all of these adjustments would have already been made. Okay. So it was just a brief overview which I think was required currently, because we don't need to get into too much details around that aspect. We can now move on to the next principle, that is about another requirement before we move on to consolidation, and that is alignment of accounting policies. See, when two companies will consolidate their financials, say we have this company 1, which is, let's suppose, Aditya Limited, and let's suppose we have another company which, let's suppose, is Vasudha Limited. And when they are consolidating their financial statements, it's important that the accounting policies which have been used for preparation of their financial statements are aligned. If the accounting policies are not aligned, then what will happen? Some of the line items, say the way inventory has been recorded for this company and for this company, would have a different criteria, which is not appropriate. They must be recorded using the same criteria. That's very, very important. And that's why whenever consolidation is done, before that, alignment of accounting policies is important. Alignment of accounting policies should be done. That's important. Yeah. And if there are any differences in the accounting policies of any of the group companies, those need to be changed for the purposes of consolidated financial statements. Okay, and this could be in respect of any of the accounting policy, but that's a must. So now, about this uniformity of accounting policies, whenever there is any change, alignment of accounting policies will be understood with the help of an example. So we can move on to illustration number 10 to discuss about this uniformity of accounting policies and how this needs to be incorporated whenever there is any change. Let's move on to illustration number 10 on page number 10.46. Illustration 10. Subsidiary B Limited provides following balance sheet. So we are given the balance sheet of subsidiary B Limited only. Okay. It has got equity, then various liabilities, assets, which are both current, non-current, and we are also given the notes to accounts. Moving on to the additional information. B Limited is a subsidiary of A Limited and both the companies follow calendar year. So they follow calendar year as their accounting year. Okay. A Limited means the holding values inventory on weighted average basis, while B Limited uses FIFO basis. So what is this valuation of inventory? It's an accounting policy. And this seems to be different for two companies. So that means we'll have to align the accounting policies. To bring B Limited's values of inventory in line with those of A Limited means to bring in the consistency in terms of accounting policy basis which values of inventory of B can be changed. The value of inventory of B was required to be reduced by 12,000 at the end of year 20x0 and by 34,000 at the end of 20x1. B Limited deducts 1% from trade receivables as a general provision for creating provision for doubtful debts. Prepaid expenses in B Limited include advertisement expenditure, which is carried forward of 60,000 in 2000x0 and 30,000 in 20x1. This being a part of initial advertising expenditure of 90,000 in 20x0, which is being written off over 3 years. Similar amount of advertising expenditure of A Limited has been fully written off in 20x0. You are required to restate the balance sheet of B Limited. So in this case, you are not required to prepare the consolidated balance sheet. It's only about changing the balance sheet of B Limited. After considering the above information, for the purposes of consolidation. Means now when this balance sheet of B Limited will go for consolidation, it's important that any changes required therein are made. So it's required to change this balance sheet with the above information wherever you feel appropriate. Second, would the restatement be necessary to make the accounting policies adopted by A Limited and B Limited uniform? Now this question has got two parts. One is practical, wherein you are required to prepare the balance sheet of B Limited, and second is theoretical, wherein you need to answer this question, wherein you will give the guidance of AS21, which requires that whenever there is any change in the accounting policies of the group companies, then those should be made uniform by aligning their accounting policies. Okay, clear? Now, this I understand is very easy for all of you. Correct? Yeah, I don't see this to be a problem at all. So that's why you can just start solving this on your own quickly. Okay. During the break, if you want to just continue with this, you can continue with this. And if you don't want to continue, you can just take it as your homework. I really don't want to get on to this because this is a very, very simple one. After the break, you can just start sharing your queries around this illustration if you would have covered this. If not, then once again, it's not a big problem. You can just mark it as your homework and we can have a discussion around it in the next session. Okay, yeah. But better if you can just try to solve this because it won't take you much time. The only thing is it will take away your break. After the break, we will discuss some small concepts which are based on this consolidated financial statements, and then we will also start with a new chapter. Okay, all of you clear on this? Yeah, great. So let's take a break of 10 minutes, and after the break we will discuss this one as well as the next one. Vijay? So let's continue. We can look at some principles around consolidation. And if you have any query in respect of this illustration, we can also discuss that. In case you have attempted this, otherwise mark this for your homework. You can all go to treatment of subsidiary company having preference share capital. So this is page number 10.5. And let's understand this. So what is the requirement in respect of consolidation when we will have a subsidiary which has got preference share capital, and this preference share capital is towards the holding. While preparing CFS, outstanding cumulative preference shares issued by a subsidiary are considered in the same manner as any other liability, like debentures, etc. Accordingly, the cost associated with such cumulative preference shares need to be adjusted for. Therefore, while computing share of profits or losses of the subsidiary, the parent should make adjustments in respect of preference dividends which are outstanding in respect of cumulative preference shares issued by the subsidiary and held outside the group. Because such preference shares represent external liabilities, means they are in respect of payments to be made outside the group. It would be appropriate for the parent to compute its share of profits or losses after adjusting for shares for subsidiaries' cumulative preference dividends, whether or not those are available or those dividends have been declared. However, in case it's non-cumulative preference shares, nothing is required to be done. So let's understand. So this is holding subsidiary. Subsidiary has got preference share capital. Now the principle says that this preference share capital is in the nature of liability. Now these could be non-cumulative preference shares. If these are non-cumulative preference shares, nothing needs to be done. Nothing needs to be done as regards dividend on the preference shares which has not been declared. Dividend not declared. But in case these are cumulative preference shares, then irrespective of whether the dividend has been declared or not, a liability towards that dividend needs to be created. Dividend needs to be conceived. So this is the principle that you should remember. So though we don't have any questions based on this, but still it's better to have this understanding, so that, let's suppose if for some reason this is picked in the exam, so you should know about it. Okay, yeah. Next is about alignment of reporting dates. We have already talked about it. Now coming back to the questions which have been raised by all of you on this illustration number 10. So Kanya is asking, sir, while calculating 1% of trade receivables, they didn't consider 99 into 1. Why we cannot take direct 1% of trade receivables? So let me just go to the computation. So they have taken 9,000 as the amount. And the question says, B Limited deducts 1% from trade receivables. So that means 8,91,000 is after deduction of that provision. So this means 8,91,000 represents 99% of the amount. So if we gross it up, what do we get? 9 lakh, from which if we reduce 8,91,000, we get 9,000. Okay, it's net amount. Shaksham is asking about adjustment in reserves. So adjustment in reserves is one for the provision for doubtful debts we have discussed. Second is for the changes which will arise due to change in the policy. Yeah, for which once again the impact is given in the financial statements. Sorry, in the additional information only. Next is about advertisement expenditure. Now the question says, this advertisement expenditure was started in 2000 X0 and this was to be written off over 3 years. 30,000 was written off in that year. Okay, 30,000 was to be written off in that year. And next 30,000, when would that be required to be written off? In X0. And next 30,000, when would that be required to be written off? X1. Okay. So it says prepaid expenses include expenditure which is carried forward, means this has not yet been written off, amounting to 60,000 in X0 and 30,000 in X1. So in X1, 30,000 is outstanding. But if we talk about advertisement expenditure, its amortization is not possible. Currently, the policy speaks about amortization over a period of 3 years. But advertisement expenditure, as per the requirements of accounting standard number 26, is required to be written off in the year of incurrence. So that's why this 30,000, which is still outstanding, we will charge it to P&L. Okay. Moini, I'm hoping that you're clear on this adjustment now. And I think this was the query from most of you. Aditya is asking, sir, why no adjustment has been done for opening inventory? So there's a note in the solution if you'll read. No adjustment has been made in respect of opening inventory as it will not impact the P&L. So if you adjust the opening inventory, you need to evaluate whether it will impact the P&L or not. Because if it doesn't impact the P&L, then it will not get adjusted. Yes or no? It's only about the closing inventory which goes to the balance sheet which needs to be considered. Okay? Clear? Shaksham is clear on this, and I'm hoping the same for all of you. And with this, we come to an end to consolidated financial statements. And as around consolidated financial statements, I've been receiving this query from Shaurya, who has been asking me about some questions related to the questions given at the end, which we can come to that later on. Shaksham, if you can be very specific on your query, we can have a discussion around that. Sorry, Shaurya. And all of you, I would suggest that you should practice more questions. The one that we have been discussing in the class are definitely good enough for the purposes of our understanding of the concept, but you should practice more questions, and the questions are given in the study material. At the end, there are so many questions available. Okay, some of the questions related to illustrations, even though you would have solved, you should practice that once again. Okay. Sangeeta is asking why the alignment adjustments are done in the reserves. Because you are required to prepare only the balance sheet in this question. If the question would have required you to prepare P&L, you would have adjusted those in the P&L also. Because please understand, the eventual impact of any adjustment in the P&L will go to the reserves, and currently in the balance sheet you are required to show the reserves. So that's why your reserves have been shown as adjusted, irrespective of whether that is coming from P&L or not. Okay, so that's why it's not gone to the extent of P&L. If the question would have required you to adjust the P&L or prepare the P&L, then you would have shown the adjustments in P&L also wherever it was applicable. Clear? Sakshi has completed this. Very good. Illustration number 10 is done. Very good, Sakshi. Okay, so now I will start with a new chapter. We can move on to banking companies now. Subrat is now clear with this. Okay, and I can see a lot of queries coming up which is not really related to this illustration, and that's why I would suggest you can just park your queries, please. I'm starting with a new chapter now, banking companies. So banks we all understand. I don't really see any need to talk about banks in detail with you. It's a very, very common thing for all of you. You all know about banks. And you must have transacted with the banks quite a lot. Yeah? So what really is the purpose of the bank? So if you really look at the requirements for the purposes of the bank, banks are there to accept deposits and lend money. So if you look at the set of activities in respect of banks, they are really focused towards two set of activities. One, they accept deposits. For example, everyone means all of you must be having a bank account. Correct? And that bank account is nothing but a savings account. And you must have kept some money in that account. So in this case, what has the bank done? Bank has accepted a deposit from you, which could be in various forms. It could be a savings bank account, it could be a fixed deposit account, it could be a current account, it could be a recurring deposit account. So there are so many ways through which bank may accept deposits. Now this current account or this bank account which you will have with the bank, you will say it's an asset to you. Correct? Why? Because you can receive this money at any point of time. It's an asset for you. But let's look at the perspective of the bank. bank is required to pay money against your savings bank account to you. That's why it will become liability for the bank. Yeah. So if we talk about savings account for bank, it will be a liability. On savings bank account of yours, you will also be getting interest every quarter. Now this interest which you receive from the bank, you will call it as income. But let's look at it from the perspective of bank. Bank has to pay this. For bank, what would this become? It's an interest expense for the bank. Yes or no? For the bank, what do you call it as? It's an interest expense for the bank. Correct? Similarly, there must be some money which the bank would be lending. So let's understand about borrowings. Okay. Say for example, there's a company, Shaurya Limited. Shaurya Limited goes to the bank and asks for money. Why? Because Shaurya Limited needs money. So Shaurya Limited has taken a loan from the bank. So bank has given a loan. On which Shaurya Limited will pay interest to the bank. Now, whenever you will understand any of the transaction related to bank loan, what will you assume? The immediate thought that will come to your mind will be that for Shaurya Limited, it's a loan, it's a liability, correct? And this interest which will be paid by Shaurya Limited will be an expense. But if you look at it from the perspective of bank, this loan which has been given is what? It's a receivable, it's an advance, it's a loan which is given. So for the bank, this would become asset. And this interest which the bank would be getting will be what? Interest income. Yeah. So my perspective of discussing all of these points with you has been that during the course of various transactions that we do in normal course, we develop an understanding of certain concepts which sort of get embedded in our mind. And the moment we see that transaction, it appears as if it should be like that only, which may not be the case. And for example, if we talk about borrowings from a bank, now it's not necessary that it will be a liability. We need to just check whose books of accounts we are looking at. If it will be Shaurya Limited, it will be a liability, but if it's bank, it will not be a liability. Okay? Yeah. So for bank, and whenever you will be looking at the questions of the banking companies, this confusion may come to your mind quite a lot. So that's why you have to be changing your perspective when you will be looking at the accounting of banking companies. Okay? Yeah. Though it's not difficult, but it's important that you need to just be careful when you look at any of the transactions from the bank's perspective in terms of its assessment. Now, if you look at the bank, there are two most important components in their balance sheet and their P&L. Banks also prepare their balance sheet. Banks also prepare their P&L. And what are those two common important components? One is the advances which they give. Advances which they give. It's a significant portion, or you can say one of the most significant component of the balance sheet of the bank. Because on the basis of the advances given, banks will be able to survive. Banks will be able to run their business. Because what's the business of the bank? To give funds. And that's why the income which they generate, all the sales of the bank will be what? Interest income. Because by giving loan, what do they receive? Interest. Similarly, another very important component in the balance sheet of the bank you will see will be the liabilities, and that will be in the form of these deposits. And corresponding to this, a significant portion of the P&L will be towards the interest expense, which will be paid towards these deposits. Okay. Now, as regards the banks, considering the fact that the banks are there for public dealing, public interest is involved in the bank very significantly. That is the reason why banks are highly regulated. Banks are subject to various regulations. Yeah, so we can say there's also a regulatory body which regulates the banks in India. And which one is that? Reserve Bank of India. And the banks are governed by various laws. So you can just say there are so many laws, regulations, whether it is about Banking Regulation Act, or whether it is about some of the State Bank Acts, or whether it is about some of the provisions of RBI. All of those are mandatorily required to be followed by the banks. And from that itself comes the preparation of financial statements. For the banks, the format of the financial statements is also prescribed. So if all of you can go to page number 8.1, we will first of all get a feeler as to how the balance sheet, how the P&L of the bank will look like. What is it all about when we look at the financial statements of the bank? So if you can just move to page number 8.19 now. You can see this Form A. What is this Form A? Form A is nothing but the balance sheet. So the balance sheet is called by Form A. So term Form A is attached to the format of balance sheet of the bank. And this has to be strictly prepared in this form. So in the exam, if you get the question of the banking, you will have to make sure that this format is followed. Secondly, the note number which you see in this format will have to be kept same. Whenever you prepare the financial statements of a company other than bank, you may have note number 3 for borrowings, you may have note number 3 for other current liabilities, because for some you may prepare the note, for some you may not prepare the note, and that's why the note numbering may change. But it is not possible to do the same in respect of banks. In respect of banks, it's all prescribed and it has to be strictly followed. Yeah, so to that extent, you will have to remember the format of the bank, and it's not too difficult. It's very much on the same lines like there's any other financial statement. So if you see, it starts with capital and liabilities, capital, then reserves and surplus, then the deposits. Why? Because these are liabilities. Then the borrowings, because these are those liabilities which the banks would have borrowed, and other liabilities and provisions. Now moving on to the asset side, the way assets are recorded, is different from the way assets are presented in the balance sheet of the bank are different from what you see in case of financial statements of a company other than bank. If you'll see about assets, there's a pattern which has been followed. Can any of you observe that and let me know what is so specific in respect of balance sheet of a bank as around assets, or as around the presentation of assets? Section, it is page number 8.19 now. And please don't remain worried about the page, because you need to understand the concept. And please remember that it's the new study material. So if you will be referring to old study material, I'm not too sure about the page number. Yes, quickly. if you can let me know one specific thing about the presentation of assets in the balance sheet of a bank, quickly. Okay, great. Shura is saying, and same is the response from Mohini, that it's in the order of liquidity. So the assets are presented in the order of their liquidity. Same is the response from Raga. Very good. So the banks present their assets in the order of their liquidity, and same thing you will also have to follow. But this order of liquidity is fixed for you now, and the same thing you need to follow. If you go to the P&L on the next page, so now in terms of the revenues of the bank, what do we have? Interest income and other income. And on the expenditure side, what's the most important component? Interest expense. And then, of course, any other expenses which are there. Okay. And all of these notes, note number 1, 2, 3, 4, 5, 6, all of these have been detailed out. I think towards the end, these have been given in detail. Let me just tell you the page reference for this. Just a minute. Let me just give you the page reference wherein you can go and read. You don't need to do that now. You can do that later on. And you should ensure that you have done this so if you can go to page number 8.126. Page number 8.126. All these notes, note number 1, 2, 3, 4, all of them in detail have been given. You should ensure that you read it once. You don't need to learn it. Okay, so please don't remain worried whether we need to learn all of these. No, I don't think so. But with practice, you will be able to memorize most of these points. And it's very important that you read all of them. Okay, clear? Yeah. The reading of all of these notes is very important. Aditya is saying in reverse of that of actual balance sheet. It's not the reverse. It's in the order of liquidity. That's what you should understand. Shivendra is asking, sir, in the balance sheet, it is mentioned fixed assets, but should they write PPE instead of fixed assets? They should, but for now, the format still refers this term as fixed assets. So that's why you should continue writing it. And in the exam also, you should continue writing it in case of banks. Okay. Mukmala is asking, sir, why borrowings in under liabilities? Because the banks may also have borrowed from other parties. So this is not the borrowings of the customers, because those will be assets for the bank. It's the borrowings which the banks would have borrowed. And as around investments, banks can also make the investments. So if the banks are making any such investments, those will be appearing under asset side. And all of these things you can understand in more detail when you go to the details of those notes, which are specified on this page. Okay, now moving further on to the capital funds, or we can say the capital of banks. So let's understand about the capital of banks. Capital of banks can be of two types. One is tier 1 capital and second is tier 2 capital. If you look at the core capital of the bank, pure capital, which is got only the components of capital, means purely the component of capital, that will be called as tier 1. Conceptually, if you have to understand about this. But the capital may also have some other components, and which may not really be considered to be the pure capital or the core capital, and that capital is called as tier 2 capital. Both of them in a combined manner will be considered to be the capital of the bank, and we can understand about these two by reading the components of tier 1 capital. So let's understand, what does this tier 1 capital include? Paid up capital, statutory reserves, if there are other disclosed free reserves, including security premium, perpetual means which doesn't have a time frame, non-convertible preference shares, eligible for inclusion as tier 1 capital. And why would they be eligible? As per the requirements of the law, that will be specified there. Innovative perpetual debt instruments which are eligible for inclusion as tier 1 capital. So this will again be notified. Okay. Capital reserves, if there are any, which represent surplus arising out of sale proceeds of assets. Okay. These are the components of tier 1 capital, and from all of these components of tier 1 capital, we need to reduce. What are those components that we reduce? Intangible assets and losses of the current period and losses which have been brought forward. Those are required to be reduced from all of the components we have discussed. Creation of DTA results in increase in tier 1 capital of a bank without any tangible asset being added to the bank's balance sheet. Therefore, deferred tax asset should also be deducted from tier 1 capital. Okay, that should also be deducted from tier 1 capital. Yeah. So this is about the components of tier 1 capital and what are the exclusions we need to make from tier 1 capital. If you see the components of tier 1 capital, what does it comprise of? Reserves, pure reserves, free reserves, paid up capital, some of the preference shares or some of the convertible instruments or the debt instruments which are eligible for inclusion there. And those are perpetual, means those will never be repaid. So that's again a kind of capital only. Yeah. That's why tier 1 capital is also considered to be the pure capital or core capital of the bank. It doesn't mean that tier 2 capital is not considered to be the capital. This is also the capital, but just that it's the core capital as far as banks are concerned. Now moving on to tier 2 capital. Let's understand what does this tier 2 capital comprise of. there are various components of tier 2 capital, and which can be best understood though with the help of an example, but still let's flip through some of these components. Okay. First, undisclosed reserves and cumulative perpetual preference assets. Revaluation reserve. Now it's a reserve, but this revaluation reserve will not go to tier 1 capital, it will go to tier 2 capital. General provisions and any reserves for losses. Hybrid debt capital instruments. Subordinated debt, investment reserve account. Investment reserve account, FCTR. All of these components will go to tier 2 capital. Now, there is another concept of risk-adjusted assets. Let's understand this. Risk-adjusted assets. Moving on to page number 8.36. We can say risk-adjusted assets or risk-weighted assets. This may be known by different names. Now, all the banks are required to assign risk weight to their assets. What is this risk weight? Means what's the risk which is attached to the assets which they have got. The risks which are attached to the assets which the banks are having, what's the proportion? Yeah, and all of these norms are coming from the regulatory requirements. So banks are not required to do this assessment. All of these norms are coming from the regulatory authorities, regulatory requirements. So on this page, there's a table which specifies various risk percentages, and that's why we call it as weighted risk. Means for the assets, a weight has been assigned to the assets towards the risk. First, cash or the balances with RBI. There's no risk. Why? Because it's maintained with RBI. So that's why risk weight in this case is 0%. Balances in current account with other banks. So even though these are current accounts with other banks, still there is a risk, and that is 20%. Investment in government securities, free from risk, 0%. Other investments, those are risky, and that's why it's 100% risk. Loans and advances which are guaranteed by the government, 0% risk. Bank premises, means the building of the bank, furniture and fixtures. These are subject to various risks. Other loans and advances subject to various risks. Any off-balance sheet line items like LCs, letter of credit, bills, etc., they have got risk, 100%. Non-funded exposure to real estate, risk is 150%. And the details around various other assets in terms of the risk which is attached to them is further given on page number 8.126. When you continue on that, you will get to see more assets with the risk weights attached to them. Okay. Many of you would still be wondering, sir, what is this tier 1 capital? What is this tier 2 capital? What is this risk weight? We have not understood this. Yeah, many of you must be thinking about it. Don't worry. We will understand about all of these concepts when we move on to the example. Before that, we will also capital adequacy norm. If you want to, page number 8.28. Capital adequacy norms. Mukmala, please wait. So all of these things anyways will do. So please wait. Automatically all of your questions will get answered. So I can see a lot of queries coming from your side, and which is mostly towards the part we have not yet covered. So please hold on. Aditya is asking, sir, what type of questions come from this chapter? Theory or numerical? I don't think there is any prescribed there's anything prescribed in respect of any chapter that only the theory will be picked up from that chapter, only the practical will be picked up from this chapter, or the mix. So that's why each and every chapter is important for you, and you never know in the exam. Yeah, some of the surprises you can see. So you may think that this chapter is something which is only meant for theory, but you may see a practical example coming from that chapter. All right. So that's why it's very, very important to just ignore all of these things and focus on the concept. Try to cover this 100%. After that, you will be confident. So whether they ask you theory or practical, you should be ready for both. Capital adequacy norm. So what is this capital adequacy norm? Capital adequacy ratio. Because the banks are regulated, that's why they are required to maintain certain ratios. Okay, which is mandatory for them, because this comes from the regulatory side. What is capital adequacy ratio? So let's understand. Capital adequacy ratio means capital funds, means capital divided by risk-weighted assets plus off balance sheet items into 100%. Currently, it's prescribed that the capital adequacy ratio for the bank should be 9%. Means every bank should compute this ratio for itself, and it should be minimum 9%. Means capital should be covering at least 9% of these assets. You remember short current ratio? What is current ratio? Current assets divided by current liabilities. It is always considered that current ratio should be 2:1. Means current assets should generally be double of current liabilities. Then it is considered to be healthier. Yeah, same is the case over here. But this is regulated, this is mandatory. So all the banks are therefore required to ensure this. Now let's move on to one illustration through which we will get clarity around this principle. Moving on to illustration on page number 8.37. Many of your doubts related to the concept we have discussed should get clear after we complete this. A commercial bank has the following capital funds and assets. Segregate the capital funds into tier 1 and tier 2. find out risk adjusted assets and the risk weighted assets ratio. So we are given various types of funds and the assets. So let's go to the solution. So what's the first step? We will compute tier 1 capital funds, or we can say tier 1 capital. Tier 1 capital. Equity share capital. Will this be tier 1? Yes. Equity share capital. So the numbers are in lakhs. 480,000. Okay. Statutory reserves. Tier 1. Yes. So what's the amount? 280,000. Next, capital reserve. Will this be tier 1? Yes. Of which 280 lakhs were due to revaluation? No, revaluation will not be tier 1. And the balance due to sale. So the balance which is due to sale, that will be tier 1. So capital reserve will be tier 1. And a part of capital reserve will also be tier 2. So what is this? 1210 minus 280. So what is this amount? 950. So this is tier 1. The remaining are the assets. So we don't see anything else other than this which will go to tier 1 capital. So what is the tier 1 capital? 76930. Okay. Yeah. Now, moving on to tier 2 capital. Tier 2 capital. Let's start with capital reserve. On the capital reserve, what do we see? The capital reserve which is arising due to revaluation. So this is nothing but the revaluation. So what is this? 280. Correct? Now do we see any other capital etc.? No. So a discount to the extent of 55% needs to be considered in tier 2 capital always. 55% of this. So what will it come out to be? 154. So therefore, tier 2 capital will be 126. Okay. Now you may be thinking about this discount, why this discount has been taken. It's not given in the question. It's as per the regulatory requirements. So if you want, you can also write in your notes that a discount towards this to the extent of 55% will have to be taken. Okay, so tier 1 and tier 2 capital we have computed. Now what's the next step? Risk adjusted assets. So we are given various assets. We need to adjust them with risk. Risk adjusted assets, or you can say risk weighted assets. Depending on the term which the question uses, we'll also use that. So 1, cash balance with RBI. Cash balance with RBI. So what's the risk? Sorry, for what's the amount? Then the risk adjusted amount. So the amount for this is 480. Then the other one is balances with other banks. Balances with other banks. This is 1250. Okay, we'll compute all of them in one go. Then we have claims on banks. These are also the assets. Claims on banks 2850. then we have other investments. Other investments are 78250. So I think this comma has been a problem now. Then we have got various loans and advances. Vijay Shankar, that is for tier 2 capital. Now on loans and advances, what do we see? Guaranteed by government. One is guaranteed by government. This is 12820. Second is guaranteed by PSU of central government. Guaranteed by PSU of central government. 70210. Next, others 520250. Then we have others 520250. Okay, I'm just putting down all of this information currently. We have not gone on to the assessment. Next is premises. Then furniture and fixture. And this is 18200. Then we have other assets. This is 20120. Okay, so we have got the total assets. Now let's assign risk weight. Something which is with RBI, zero risk. Balances with other banks, we discussed 20% is the risk. Claims on banks, 20. In the schedule, which is towards the end of the chapter, as to how did we get 20. Other investments, risky, so it will be 100. Something which is government guaranteed or guaranteed by central government, it's 0%. Others, 100%. Premises, 100%. So all these are 100%. Now what's the risk weighted amount? Very simply, this into this percent. You can say this is percentage. Yeah. So if we compute this, this will be 0. 1250 into 20%, 250. 2850 into 20%, 570. 78250 into 100%, 78250. This will be nil, this will be nil, and this will be same figure. 18200, 20120. And then we can take the total. Huh? Can you compute the total, please? 637640. 637640. So we have computed risk-weighted assets. Okay. We have also got off-balance sheet items which are 100% risky. Off-balance sheet items which are 100% risky. So for them, the amount will be again same 370250. Off-balance sheet items. That is 370250. This is what 100%. So this becomes 370250. And the total of risk-adjusted assets plus of balance sheet items will be, let's suppose this is A, this is B. So what do we get as the total? Sure has solved this question. Very good. Radha is saying others which is guaranteed by government. Should this be 0? Yes. But this others is not guaranteed by the government. You will see 1007890. Okay, so that's the total that we get. Now we are required to compute risk-weighted assets ratio. What is that? Capital ratio only. Sorry, capital adequacy ratio only. That is easy to compute. As I told you, it's known by different names, but it's one and the same thing. Risk-weighted assets ratio. Risk-weighted assets ratio. This means tier 1 capital plus tier 2 capital divided by risk-weighted assets plus off balance sheet items risk adjusted into 100. So tier 1 capital do we have? Yes, it's 76930. Then do we have tier 2? Yes, it's 126 divided by risk adjusted assets. Do we have that? Yes, it's 637640 plus off balance sheet items 370250. 370250 into 100. So can you solve this and let me know what's the answer you are getting? Okay, I think Darshita has solved this. Darshita is saying it's 7.65%. Now, in the given case, and Mukmala, I need your attention now. In the given case, we see this ratio to be 7.65. But as per the norms, what's the ideal ratio? The ideal ratio is 9%. So that means this bank will have to do either of these two things. Either this bank should increase the capital. If the bank will increase the capital, this percentage will increase. Or the bank should cut down on any of these assets, which will again lead to increase. And this increase or decrease should be done in such a manner that this touches 9%. Why? Because that's the regulatory requirement for the banks. Banks need to maintain this ratio. Okay. Clear? Mukmala, you are clear on this? What's the expected ratio? That's what is called as expected. Expected means ideal, that is required. But this bank doesn't have that. So if this doesn't have that ratio, it will have to reach up to that ratio. That's required on the part of the bank. And as I told you, it's a mandatory requirement. All the banks do this. All the banks are required to make sure that all of these ratios are achieved. Okay, clear on this part? Clear on this? So with this, we come to an end to our discussion for today. So today we have started with this banking, and of course we'll continue with this banking in the next session, and we'll also be starting with the NBFCs after this, because these two are very much interrelated. And banking and NBFC, we have seen, generally is considered to be a complex topics and generally is excluded from your purview of the things we should not do. You'll see, can you see this question up? And same thing you'll see during the course of our discussion, that this chapter is not difficult at all. It's just that you need to make sure that you read it once, because if in the exam this is asked, this can be very scary. Okay, yeah. So just make sure that this part related to the banking that we have covered, you revise it before we meet next. Okay, So thanks to all of you. This is the homework, Aditya. This is the homework for you. That before we meet next, you should just make sure that you read this part. And in the next session, we will continue with our discussion on banking. Thanks to all of you. Thanks so much.